The 18th sum. ABC company has taken a loan from their foreign collaborators for $2 million. Interest is payable on maturity at LIBOR plus 1%, and the 6-month LIBOR is given to you as 2%. So the total interest rate per annum is 3%, right? We would want the equivalent 6%, so then it has to be 1.5%, correct? This is a 6-month loan, and the loan is for the amount is 2 million and it is in dollars, correct? Now, inquiries regarding exchange rate with their bank elicits the following information. The spot is given to you and the 6-month forward is given to you as 48.5275 and 48.4575. If you see, the rupee, or what is at a discount, rupee is at discount or the dollar is at discount. This is a direct dollar quote. If you see, 1 USD is equal to, right, $1 is equal to, this quote is interpreted as a rupee by dollar quote, a direct dollar quote, right? So this means the, if you see, 48.5275 and 48.4575, the rate, the quotation is at a discount, but which, it's the dollar quote, a direct dollar quote, so the dollar is at a discount, okay, which is a rare occurrence. Generally, if you see, when you compare rupee and dollar, which are the two currencies involved in this case, the dollar would never really be at a discount, but in this case, this is what is actually being seen from the quotations given to us, right? Next, we'll read further. What would be their total commitment in rupee? Total commitment in rupee if they enter into a forward contract, okay? And will you advise them to do so? To do what? To enter into a forward contract, and explain the reasons. Okay, so first thing we do that, the total commitment in rupees if they enter into a forward contract. This is a very simple question, right? The forward contract, the forward rate is given to us here, and the amount is $2 million also given to us, and the interest is also given to us. So we calculate the interest first. Interest is equal to 2 plus 1 percentage. This gives me 3% per annum, but what I want is 6 month, so it has to be 3% into 6 by 12, and the amount is 2 million, so 5 zeros, right? What I 50 or 60, 1 million is equal to 10 lakh, so this has to be 6 zeros. Okay, let me just do the commas properly. Great, correct. Now, so what do we have here? Into 3% divided by 2 is 30,000. 30,000 what? Rupee or dollar? Dollar, because this 2 million is dollar, okay? So this is basically the interest, the 6-month interest on loan, correct? And the loan amount is equal to $2 million, correct? Yeah. So finally, when you add up your total expenditure, your total outflow has to be 20,30,000, correct? What? Dollars. Okay, now they have asked the total commitment in rupees. So till now we have the total commitment, but in dollars, okay, 20,30,000 dollars. In rupee, we'll do that using the forward rate. The forward rate is this rate, 48.4575. Okay, therefore total commitment in rupee using 6-month forward rate of rupee by $48 point, what was it, 4575? Yes, 4575, correct? This is the rate. So therefore I have dollar 20 lakh 30,000, and what I have is a direct dollar quote. I have the exposure is also dollar, so multiply or divide, I have to multiply. So then this is multiplied by rupee by dollar 48.4575. This, when I multiply it, the dollar cancels out, and I am left with the equivalent rupee, which is how much you need to calculate this. 2030 into 48.4575 would give me 983.68 725 what rupee. Okay, so this is the final commitment in rupee, okay, using the forward contract. This is the first part. Now in the second part of the question, they've asked, will you advise them to do so, to enter into a forward contract, and you also have to give the reasons. Now once again I repeat, the dollar is at a discount. We saw that why. See, dollar is the standard currency here, and it's basically a direct dollar quote. And since the, see, if I give 1 rupee today, if I pay $1 now, I will get 48.5275 rupees in exchange of that $1, and after 6 months, in exchange of that same $1, I'm only getting 48.4575 rupees. So basically this is dollar being depreciated and rupee is at a premium. Okay, so I hope that is understood. They are saying, will you advise them to enter into forward contract? See, now let's write this in words. The market, as per the quotes given in the market, the dollar is depreciating as per the market quotations given, right? And if the firms or the organization's expectation is that the dollar will depreciate even further, the dollar will depreciate even further, if the firm anticipates this, then it is better not to cover the transaction. Okay, because the firm is thinking that actually after 6 months the dollar will depreciate even further than 48 point, how much was this, 48.4575. okay, so then the firm has to pay even less than this particular amount that it is paying if it hedges the contract or if it covers the contract today, right, at 6 month forward rate. So, but generally if you see, logically, as I even mentioned at the start of the question, is if you consider dollar and rupee, I mean in both of these currencies, of course, dollar is generally always at premium. So once in a while if it is at discount, does not mean always that is going to be the trend, because from the past analysis you could see that. Okay, so on a very logical basis, it is always advisable in this particular case, where rupee is the weaker currency as compared to dollar in the general market scenario today, we logically we advise the company to cover the position, okay, based on the market conditions. So based on the past market trends and general stronger dollar currency, it is advisable to cover the transaction. And when you cover the transaction, basically when you enter into this the hedge transaction, hedge and cover both are the same. You are basically fixing that particular amount. So now when you've entered into the 6-month forward transaction, this is the final amount which will be the outflow. After 6 months, whatever be the actual rate, this is the fixed amount that you have to pay as the organization. There is no more than this, there is no less than this. So at this particular point, at spot today, you know what will be your outflow. So then you can always decide your economic activity. So that is the reason. Okay, yeah, so this is basically the end of the question. If you need to see the reasons correctly, we can also go to the study material once and just read that. Okay, we'll just wait a minute, we'll read this part. See, it is seen from the forward rates that the market expectations is that the dollar will depreciate. Yes, we know the forward rates, right? This was one of the forward rate, 48.4575. Then the market rate is depreciating and the spot was 48.5275. Okay, there's a depreciation. Yeah. If the firm's own expectation is that the dollar will depreciate more, the firm's own expectation, it is anticipating that the dollar will depreciate more than what the bank has quoted today, it may be worthwhile not to cover the transaction and keep the exposure open. Why you are not covering the transaction is because you think that dollar will fall even more than what the bank is quoting, than what the market is quoting. So then eventually you have to pay even less than that. So then you are keeping your exposure open. Now if the firm has no specific view regarding the future dollar price movements, it would be better to cover the exposure. This would freeze the total commitment and insulate the firm from undue market fluctuations. In other words, advisable to cut the losses at this point of time. Given the interest rate differentials and inflation rates between India and US, it would be unwise to expect continuous depreciation of dollar. Yes, the US dollar is a stronger currency than the Indian rupee based on the past trends, and it would be advisable to cover the exposure, that is to hedge the exposure using whatever forward, future or options. In this particular case, it's forward, right? I hope you've understood this question correctly, right? Okay, bye.